and we will credit accumulated depreciation for 40. So this is the expense. What about the accumulated depreciation? What is it? What exactly this account? This is a special account that we call it a contra asset account. So this account will be we will be classified with assets, but it will be deducted from assets. That's why we call it contra asset. So it's included with the assets, but not added to the assets, but deducted from assets. Now, that's why you can see that the equipment, the accumulated depreciation, it's balanced on the credit, but the equipment, it's balanced on the debit. So it has the opposite side. So the asset balance that normally will be on debit, but accumulated depreciation, because it's a contra asset, its balance will be on the credit. So now for the accounting period, which is the month of October, there will be an expense of 40. Now, how that will looks like in the statement of financial position, or we call it the balance sheet. In this statement, we will have the equipment that we purchased for 5,000, so its cost is 5,000, and we will deduct from this something called accumulated depreciation, which is now 40. So the remaining, so the balance, we will call it a book value. The book value is simply the difference between the cost and the accumulated depreciation, which is now 40. Why we call it accumulated depreciation? Because the depreciation depreciation expense will be accumulated in this account. So for example, in this month we have 40 of depreciation. Next month we'll have another 40. So in the accumulated depreciation we'll get a balance of 80. So we'll deduct from the 5,080. In the next month also we will add to that another 40. So it becomes 40 plus 40 plus 40, 120. So we'll deduct from 5,120. So that's why we call it accumulated depreciation. So go back again to the previous slide. So for assets that that has a long life and its useful life extends over than 1 year, these assets will be depreciated, like equipment, vehicles, buildings, machines. Okay, so we have, at the end of the accounting period, we have to prepare an adjusting interest that shows how much we expense from the cost of that equipment. So when you buy the asset, the machine, the vehicle, you debit an asset and you credit cash, for example, if you paid for cash. But at the end of the accounting period, you have to record a depreciation expense by estimating how much of this cost is depreciated by the end of the accounting period. Now let's check the second type of adjusting interest, that we call it unearned revenues. In this type of adjusting entry, we have a cash receipt. We received a cash receipt from the customer, but the service will be provided to the customer in the future. So you received cash from the customer today, but you will record, yeah, but you did not perform services yet. Usually we will have unearned revenues whenever like we receive from a client. For example, we are renting one of our offices or one building that belongs to us, we're renting it to the customer. So maybe we will receive the payment for rent in advance, or maybe in the case of airline tickets, tickets, usually the customer will buy the ticket today, but we will the flight or the service, the transportation service, will be provided to the customer in the future. Same thing for magazine subscriptions. magazine subscriptions اللي هي الاشتراكات للمجلات والجرائد مثلا. So customer here in this case will pay a subscription for maybe a full year or maybe for a full month, but he will receive the magazine on a weekly basis. So in all of these examples, the customer pay today, but the service will be provided to him in the future. So that's why in example 2, if you remember, if the customer paid today but we perform the service in the future, at the time of payment we debit cash and we credit unearned revenues. We can't record service revenue. Instead of that, we will record unearned revenues. So the adjusting entry for the unearned revenues simply we will debit the unearned revenues, and we called this a liability account before, and we will credit the revenue account. So let's check this example that shows how we will do the adjusting entry for the unearned revenues. Sarah Advertising Incorporations received $1,200 on October 2 from R. Knox for advertising services expected to be completed by December 31. Unearned service revenue shows a balance of $1,200 in the October 31 trial balance. Analysis reveals that the company performed 400 pounds of services in October. So on October 2, we received 1,200. At that time, we recorded this amount as unearned revenue. We credited unearned revenue because we did not perform services. So now, by the end of the month, we have to see how much of this amount we provided as a service so far. So the analysis says that the company performed so far 400 pounds of services in October. So now the month of October deserves a revenue of 400 because we provided services for the customer by the amount of 400. So what should we do? Simply we will debit unearned service revenue by 400 and we will credit service revenue by 400. So crediting service revenue means that we are recording revenue for the month. So revenues for the month of October increased by 400. While debiting unearned revenue or unearned service revenue means that we are decreasing the liability or the unearned revenue balance. So let's check the T account or the ledger account for these accounts. So here we have on October 2 1,200 of unearned service revenue. This is a liability account. It was on credit, and because we provided services for 400, so this liability is decreased by 400 or debited by 400. So the balance of unearned revenue is 800. So next month we will provide service by maybe, yes, the remaining balance that we did not provide service for yet is 800. Now the service revenue that we record from this amount, the 1,200, is only 400. This is the value of the service that we provided during the month of October. Now we said that adjusting interest is divided into two main groups. The first one is prepayments, we said, and the second one will be accruals. Accruals are divided into two types. So we have accrued revenues and accrued expenses. Accrued revenues simply happens when the company when the company performs services to the customer, but this amount of, or like this services, is not recorded yet in the journal. And same thing with the expenses. It's just simply expenses. We have accrued expenses whenever we have expenses that is incurred but not yet recorded during the accounting period. So now the adjusting interest will play its part here at the end of the period by recording these accrued revenues and recording these accrued expenses. Let's start with accrued revenues. Usually a very famous example of accrued revenues is interest revenues and services performed to the customers but not recorded yet. So in this case we have a revenue, or we have a service provided to the customer, but it's not recorded or received yet. So what should we do in the adjusting entry? Simply we will debit receivables and which is an asset account, and we will credit a revenue account. Let's have an example here. It's saying that in October, Sarah Advertising performed services worth £200 that were not billed to clients in October. So we performed services during the month, but maybe we agreed with the customer to pay this amount in the next month. So we did not bill him yet. But because we performed the services during the month of October, so now we must, or like the month of October should take its share of revenues during the month. So what should we do? We will credit service revenue by 200 because we performed services during the month of October for 200, but we did not pay it. We will pay it next month. So that's why we cannot record cash, so because we did not receive cash yet. So record instead of that accounts receivable of 200. Now later, assume that on November 10 next month, Sarah receives cash of £200 for the services performed. So here we will debit cash by 200 and credit accounts receivable for 200. So as you can see, accrued revenues means that we performed services during the month, but we did not record this because we did not bill the customer yet in this example. So we, at the end of the month, to apply the revenue recognition. Here we should record the revenue, and the month of October should take its share of revenues for the month